Alex. Thanks for having me. I'm so happy to be here leading a session on impact investment, which is extremely important topic in this COVID world. Uh, Even before the COVID, the gap between the rich and the poor was getting bigger, which means that people at the bottom of the economy, they have difficulty participating no matter how hard they try and no matter how smart they are. And there are a lot of studies coming up showing that the COVID have widened that gap. So it is really important that we re-examine impact investment and figure out how we can increase the impact. So I am very happy to lead this panel, and I am excited to introduce two panelists with me. Alexander, would you give brief introduction of you?
So, hello everybody, I'm Alexander Hoare. I come from a family business. In fact, I'm the first of the 11th generation in the business. The business is banking, but we also tithe, that is, give about 10% of our profits to our charitable trust. And in the charitable trust over the last decade, we've become very involved in impact investing, subject very close to my heart, and that's exactly why I'm here.
Thank you. Okay, now Greg, would you introduce us?
Sure. Good morning, everybody, or good afternoon, I guess where you are. My name is Greg Neichin. I'm the director of Ceniarth, the Impact First family office of Diane Eisenberg. We can get into what Impact First is probably in this discussion, but we're responsible for around $450 million, all of it being intentionally deployed for impact in marginalized, primarily rural communities around the world. We execute about 25 to 30 impact transactions a year. We commit roughly $30 to $40 million a year. So, so we are one of the most active family office investors in the market.
Thank you. Well, we are going to have an exciting discussion because I can see that we have different perspectives. I come from the perspective of managing Aster Impact, which is a nonprofit organization incubating social enterprises and working with the family-owned businesses as advisor. Alexander comes from being one of the generation of a family business, and then Greg coming from the family office with a focus on impact. So, well, let's start with our first question. The first question is, why do we bother with impact investment? And why do we even have a separate bucket for impact investment? Why not just invest? Greg, since you are in family office focusing on investment, would you tell us why that differentiation is important?
Sure. So I guess I'm not really here to talk to folks who don't understand why impact is important generally. So I think that if you are not motivated to use capital in a way that impacts hard problems in the world, if you don't feel that sense of responsibility that comes with stewarding great wealth, then I'm not going to have much, what I say is not going to be that resonant with you. I think why I am here is to talk to people who want to get a full picture of what's happening in the impact investing market, because I think in many ways the field is not giving people a full picture of what's happening, and I think having that full picture is really essential if you're a family office that wants to have deep, genuine impact on the world's hardest problems today, whether that's intractable poverty or climate change or racial injustice. It's critical if you want to be a sophisticated, dynamic philanthropist in 2021. And really, that's who I'm speaking to. I'm not trying to convince anyone actually to radically change their investment portfolio. I'm trying to talk to families that are engaged in philanthropy and want to use investment as a tool to pursue their philanthropic mission. So I guess the first thing I want to address is, why is this field not giving you a full picture I think most of the impact investing field is oriented around this sort of broad concept of doing well by doing good, of not sacrificing anything, or making tweaks to an investment portfolio to align with values. And I think it's fine. You sort of put some ESG public equities in your portfolio, or you add clean tech or ed tech venture funds to a portfolio, and all of a sudden you are an impact investor. And this is not our view at Ceniarth. I think we believe all of these things are fine, of sort of pursuing the well-intentioned double bottom line is a good thing, but no one should fool themselves that making those adjustments to your investment portfolio are making a meaningful difference in improving the lives of people living in poverty. So we feel that that portion of the field should be called values-based investing or responsible investing, but not really impact investing. So for us, impact investing, or what we call impact first investing, is about using these investments as a tool for your philanthropic aims. It's really about maximizing impact while still preserving capital to recycle and reuse it in the future, not to maximize financial and impact and to not have any sacrifice. So this is a lot of what we do. It's figuring out how to use below market rate capital to improve communities where markets have abandoned them. It's about using catalytic subordinate debt to attract development finance institutions to transactions. It's about working side by side with grant makers on hybrid organizations that require both subsidy and working capital to get things done. So it's a really a rich, vibrant field that is supporting organizations and funds to serve deeply marginalized communities. So I guess in closing with this sort of opening question, I'm not here to convince any CIOs or families to change your investment portfolio. Actually, it's not our fight, really. What I am here to do is to try to convince family principals and CEOs of family offices that you need to think about impact investing as a tool for your philanthropic mission, because it will help you do more and be more effective.
Okay, so you are not a, I would say, supporter of the old wine packaged in a new bottle. So the same old investment now dressed as impact investment, that you are not a supporter of, but what you are saying is you see impact investment more as a sustainable way of doing philanthropic activities.
Agreed. And I just qualify to say it's not that I'm not a supporter of any of those tools, of the tools of ESG, of the tools of investing in various sectors like clean tech or ed tech or biotech. I think all of that's a good thing. And I think the fact that more families are beginning to look at this, not only more families, but more institutional investors and pension funds are beginning to use these ESG tools, it's good. So I would encourage people to do that. I just think the field has the field has too often confused that activity with activity that is going to actually impact the lives of people living in poverty, or really dig deep into some of these harder challenges that the world faces. So I think what we need is real clarity. And the confusion in the field is I think, an obstacle to people acting.
Okay, so what you're saying is like, you're saying one size fits all actually is not true, that one size fits nobody. So you feel that impact investment also should be that instead of having general term that covers all spectrum of impact investment, there should be more focused effort.
I think that's a very good summary. That distinction is critical in order to ground the field.
Okay, so since how we mention specific activities is important, and currently one issue that we face is everybody's calling everything impact investment. If you can name the type of impact investment you do in a specific way, what would that be?
Sure, absolutely. So I'll give you a few examples. So here in the United States, we do a lot of investing with community development finance institutions. These are banks, credit unions, and loan funds that exist in persistent poverty regions where traditional banks do not exist. They exist to serve marginalized communities, making loans to individuals and small businesses. They need very low patient capital, very low cost patient capital. So we do a lot of lending to CDFIs like this. To do that, you need to be able to offer 2 to 3% capital and long duration, so 5 to 10-year loans to these organizations so that they can reloan to individuals and businesses in their communities. Now, while it's a very low cost of capital, these are organizations that have worked in these communities for decades. They have strong balance sheets. They have really strong management. And so the risk of lending to these organizations is actually quite low, despite them working in challenging places. So that's certainly an example in the US of the kind of impact first investing we do. Internationally, we support funds such as Global Partnerships. They're a nonprofit impact investment firm that invests in high impact microfinance institutions as well as small businesses. And again, doing this in difficult rural places around the world. It's an example of a deal where we as a family office we're able to write a relatively small check. We invested $3 million alongside one or two other foundations, and we're able to catalyze $50 million in development finance investment from the USDFC, formerly known as OPIC. So it's another example where family office can incent big development finance money to come into a deal. Together, we created a new fund for global partnerships. And that, again, is using very low cost capital, 2%, 3% lending capital to deploy into rural marginalized places. So hopefully those are reasonable examples of what the strategy is.
And I think the key word is patient capital, because actually a lot of impact activities, it takes time to make impact. Well, Alexander, I have a question for you. Since you mentioned at the beginning when you're introducing yourself, your family have a foundation and the bank contribute 10% for the philanthropic or impact activities. How do you separate a line? What goes under foundation activities? What goes under impact investment?
First, I'd just like to say I agree with everything Greg's said and the things he's doing. I think it's tremendous. And as Leah, you've pointed out, I do come at microfinance from a foundation, and it is a great tool. Actually, we started with an allocation in the foundation of 10% to impact investing, and we arrived last year at an allocation of 100% of the foundation in impact investing.
Oh, that's a huge change.
Can I go back to your first question, why impact investing? Because it's really important, actually. The problem we need to solve is the entire asset management industry. All the providers and all the clients have done very nicely out of the status quo that is the sort of the Milton Friedman school of maximizing short-term profit. Without any regard to the cost in terms of human health and natural capital. Now, I suspect most people are aware there is a cost in terms of human health. It's showing up in a pandemic, and natural capital is all over every time you turn on a TV at the moment. But the problem is, how do we change the status quo? And nobody's got any interest in upsetting what's worked really well for them. So this is the ambition of of our impact investing in Snowball. It's a modest ambition. And I can go on, or I'll let you ask questions of how we're going to do it.
Yes, please go ahead and share.
So the first thing to say is it evolved. It didn't start with let's change the world, but it evolved with me doing what I could with 10%. After a few years, I realized it'd be stronger doing it with others. So we teamed up with another charitable trust and employed professionals. And quite quickly afterwards, 3 other charitable trusts and a wealthy family joined us. And we built a portfolio which targets all the United Nations SDGs. It's a multi-asset fund of funds. It's got everything from cash to private equity and venture capital in it. And that was step 1. Step 2, last year, it became a fully regulated fund open to sophisticated investors. Step 3 is you list it on an exchange, probably as an investment trust. So it provides liquidity, although the underlying assets aren't all liquid.
Okay.
Then you crowd in a lot of investors, all the people who've got pension contributions, all the people who've got savings, could be small people or big people, doesn't matter. And at that point, you're eating the lunch of the asset management industry. Only at that point are they going to start listening politely, nodding at you, saying, yes, this is what our younger clients want, showing you the door and thinking of a million reasons why they're not going to change the way they do things. We have to create the imperative of solving investors' needs and showing that it works with decent risk-adjusted returns. And that's what I'm trying to do.
Oh, I see. That's a very ambitious plan. And so you are trying to achieve something bigger by consolidating resources through the collaboration and setting up the structure, allowing other people to join you.
The collaboration was very important. It required altruistic investors whose return was swallowed up in building up the 4-year track record. In exchange for the opportunity to create systemic change across the entire asset management industry.
So actually, I hear from both of you, Alexander and Greg, that one of the, how can I say, myth about impact investment is people saying that, oh, you can do good while you are also making tons of money. Both of you are saying that actually that might not be the case.
So I think it depends, and I actually wanted to pick up on a few things that Alex said, because there are many things that I agree with strongly and want to emphasize, maybe with a little different spin. The first is that the sort of existing asset management business is a big part of the problem. That I would agree. And I think that part of why we have concerns about the direction that the field is going is that it's at this point now being driven a lot by traditional asset managers whose economics incentives are to continue to grow their assets under management and to keep people in their sort of universe. So this concept of doing well and doing good and being able to make relatively minor tweaks to an investment portfolio, it sort of aligns with their traditional model. And so there's this sort of capture that kind of continues to occur, that we think sort of dissuades asset owners from pursuing more sort of progressive and aggressive ways of deploying capital into impact. One thing that I might disagree with, although not a strenuous disagreement, and I sort of applaud the ambition of what Alex is doing with his sort of pooled vehicle, and I think it actually is a nice way of making it very easy for an impact investor to commit to the field. One thing I might disagree with is that I think there's actually an easier way to get some of the asset management field to change, and that is to ask. And I think that a lot of families are not even asking. A lot of families are not getting themselves clear and educated about what their goals and values are when they go and have that conversation with those in the asset management field. You know, Diane, our founder, speaks, you know, really eloquently about, you know, the sort of misogyny and bullying that she faced in dealing with wealth advisors before she created Ceniarth, and really began to sort of pursue this in a sort of you know, more comprehensive and professional way. And I think she's been very effective at breaking a lot of those walls down in the industry just by being incredibly clear, incredibly well educated about what she wants. Ultimately, we decided we couldn't work with any of these people, and we were going to build our own office to pursue this mandate. But I think there actually is a lot of value in coming to those conversations with clarity, and you know, and basically saying, I'm going to take my business elsewhere if you can't meet, you know, these three goals. There's actually quite a lot in developing in the field, and options now for individuals if you're not afraid to ask, and ask clearly.
I completely agree with that, and I'm not saying ours is the only route to change. I fully agree that, well, your advice that you must ask for change, but also that they have to have options of places they can go to. And you speak of making it easy. One of the things we observed in the UK is there were foundations who thought we should do a bit of impact investing. And what happened is it didn't sit in the investment portfolio, which they've got well organized. It didn't sit in the grant giving, which they've got well organized. And some poor finance director was running around making some impact investments, and it just muddled up everything for them. So what we're trying to do is make it easy for them just to add a line in their portfolio. It gives diverse risk and returns. It improves their portfolio, and they can say to the young generation or whoever's pushing, well, we have now started making some impact investment.
Great. Well, there's many ways to get to Rome, and I think the approaches that Greg have taken and Alexander have taken, actually, it is the right approach given your background and your resources. But I think in the end, the objective we are trying to achieve is the same. So what I'd like to ask is, you already kind of addressed it. So you shared your experience and how you came up with the strategy and went about executing impact investment effectively. What advice would you give to people who are currently not doing impact investment, but they want to start? What would be the first step? How do they go about coming up with a strategy, or do they even need a strategy, or what would be the step one?
Yeah, that question's for Greg, isn't it?
Yeah, sure. I'm happy to take a first cut at it. So I think there are I guess two parts to this answer. The first is, as I was saying, to try to get clear about what it is you're doing with this tool called impact investing. You know, I think you need to ask yourself the question: are you trying to get general alignment with your family's investing assets, or are we doing this as part of our philanthropic mission to address very specific areas of impact? And again, both of those are good, but they're two very different things. And I think before you sort of enter this field and even begin dialogue with advisors or collaborators, it's important to have a clear sense of what it is that you're trying to do, because they're sort of choose your own adventures, and they're a bit two different paths that you can take down. And I think it's important to have that clarity, or else you get sort of stuck in this murky middle between, is this an investment tool, is this a philanthropic tool? And then I think you're sort of in these endless debates about returns and trade-offs with impact. And I think if you go to sort of a conventional impact investing conference, you'll just sort of hear these endless sort of cyclical conversations about these things, because I think people are not that clear about which path they've chosen and what exactly they're doing with those dollars. So the first tip I have is just like, get clear on what it is you're using this tool for. The second tip I would say is find somebody who's doing stuff that you think is interesting, and try to do a little bit with them. I think there's no substitute for learning by doing. We built this strategy not by, Diane and I sitting together in a room with a blank piece of paper and crafting theories of change and all sorts of brilliant strategic insights. We did this by, just getting started. There's a Herb Kelleher. Herb Kelleher is the founder of Southwest Airlines. I always love to use his quote. It's, we have a strategic plan. It's called doing things. And that's really always been one of our guiding lights at Ceniarth, to just sort of dive in and get going. And I would say, if you're starting, start small, so that, when you make mistakes, and you will make mistakes, those mistakes are small enough to not be that painful, but are just the price for some education as you begin to figure out the kinds of transactions that you want to do in the impact investing world.
Well, I like your advice of copying the ones who are already doing well. Actually, just a few days ago, I read a book, and in that book, it says, if you want to be the best in the world, firstly, find out the best in the field, observe them, analyze them, copy and improve. So maybe in impact investment, maybe we can take the similar approach, because there's already people who are doing wonderful job in impact investment.
Yeah. The only thing I guess I will add is to also think about it relative to the amount of assets that you have the capacity to deploy in this field. I think that the solutions that exist in the market are radically different if you're trying to deploy $10 million versus trying to deploy $500 million. And so pooled vehicles like the one Alex has built are really ideal for, perhaps smaller mid-size investors who don't have the capacity to invest, relatively larger checks into individual funds and individual direct deals, or might not have teams to do all these things. And so that might be a solution if you're, if you have a smaller pool of capital to deploy in the field. Whereas if you're saying, for our family, $100 million is a small amount of money to sort of commit to impact. It's a big amount of money in the impact investing field. So the options available to you might be very different. So I think that also is an important factor as you begin to get into the field.
Okay. And actually, one of the things that Aster Impact does is we are trying to educate and also convince families, rather than just setting up typically a nonprofit organization, actually set up whatever philanthropic goal that they have, structured it as a social enterprise. So there's a sustainability instead of perpetually relying on donation. But as Greg mentioned previously, one of the things what people don't realize is it's actually extremely difficult running a social enterprise that really deliver measurable social impact, at the same time trying to have a huge financial gain. So we try to tell people that actually the whole point is not really trying to make money out of it. Actually, the fact that you don't have to make the donation year after year, you should already see it as a winning, because that way with the seed money, you are creating sustainable impact. So we try to educate people about the expectation to be more realistic, because it is true that it is extremely challenging balancing doing good and doing well. I'd like to give you a little bit of kind of statistics. About 5 years ago, we've done a global survey in partnership with one of the global accounting firm. So we sent out this survey to all the business families and family offices around the world. And we asked them if they have family values. And then if they do, what do you do with it? And surprisingly, of the respondents, only less than 40% of people, they said they have values. And then when we asked deeper of those people who have values, we asked them, how did you come up with the values? We were shocked that only a small percentage of those 40%, less than 10%, came up with the values with everyone in the family participating and discussing. The rest of them, it was the head of the family who decided that, okay, this is the value because that's what I believe in. And then when we asked them, what do you do with the family values? What we found out is the families where everyone participated and agreed and came up with the family values, they use it as a decision-making tool. So they say whatever activity we do, whether it is investment, whether it is the education of children, philanthropy, we always run by our family values. When they're aligned, then we will go ahead. And then they also said that family values are helping them to bind them together as a family. And then they use also family values to resolve the conflict in the family. And then on the other hand, the families who have the values, but who didn't go through the process of discussion, they said, no, it's just we have it, but we don't know what to do with it. So the question I have is, how do you see the alignment of impact investment with the family values?
Let me have a go at that. We are a partnership owning the business. We're 350 years old next year. And our mission is to perpetuate a profitable family business. And, it doesn't say anything about conquering the world, but perpetuity is quite a high aim, and it involves thinking carefully about what you're doing. And we articulated that about 30 years ago. And about 2 decades later, we held a lot of focus groups in the bank. And we came up with an agreed purpose, which is to be good bankers and good citizens. The point being, at any time there are some good banks, there are lots of good citizens, but there are very few good banks also simultaneously being good citizens. And it's in that capacity that we give a lot of money to good causes. And it's in that capacity that we worked out that having an endowment invested in BAT, we saw in the Financial Times last week, BAT was an ESG stock. I mean, what is pro-social about giving people cancer? I'd love to know. We worked out that the endowment needs to be invested for maximum impact as well as grant giving. And what we've discovered is you can build a low volatility endowment, which yields 4 or 5% per annum, good risk-adjusted returns to enable you to carry on in perpetuity. So in short answer to your question, our values are embedded in everything we're doing.
Mm-hmm. And I think that's the way it should be. And maybe that's your secret recipe for sustaining business for 350 years. I like the word perpetuity because that's not a word that's used quite often, but it is a very meaningful word.
There's a lot of talk in the a lot of talk in the business schools about winning, but it's not a game you can win. All you can try and do is stay in it.
Mm-hmm. Yes. I guess you can win once and then lose, but yes, if you stay in the game longer, Yes, you are absolutely right. That's a very good point. Okay, now the very important question. How do we measure impact?
Carefully.
Do we measure it with a pencil or?
Yeah, I'll take a quick chance at this one. And so I think this is this is in many ways the $1 million question in the field that people are always asking. I think it's another area where the field has opted to sort of oversimplify in a way that is not that useful in terms of measuring real impact. So you'll see a lot of impact reports that will mention very vague statistics about individuals served. They'll say we've invested $20 million and we've impacted 50 million lives. Well, was it a good impact or bad impact? Were there a whole bunch of unintended consequences that showed up 2 or 3 years after you made that investment? So I think that the important thing, the first important thing about measuring impact is to get your head around that this is complicated and complex, especially when we're talking about interventions that impact, again, poor, marginalized communities where there are a lot of unintended consequences. One thing we've been doing more recently is spending time with tools that allow us to talk directly to customers. We've made an investment, and I'm on the board of a business called 60 Decibels, which does a whole bunch of customer survey work in the communities that we work. So instead of us guessing whether the impact is positive, we're trying on an intervention by intervention basis to go talk to communities on a regular schedule to say, did this particular intervention, if you're a small farmer in East Africa, did getting this seed, this agronomic advice help you? Did you renew this? Did it, improve livelihood? Did you tell your neighbor about it? So these kinds of listening exercises are very important. And what we've found is really that you can't measure impact in sort of a macro level across a wide portfolio. You need to get to a level of, get to a level of your portfolio that's comparable enough that measuring impact matters, and then to look at impact in that more specific way.
Okay. Well, I think it's an issue of, do you measure output or outcome? And as Greg mentioned, very often people are more excited about output and they don't count enough outcome. And actually, this is related to earlier discussion. To get to the stage of having impact outcome, it takes time. And so the impact investment has to be a patient capital. And so if you just look at it, return on investment as a typical portfolio and expect to have a return in 3 to 5 years, that would be very challenging. And I think that kind of pressure is driving people to look at more output, because output is quicker and easier to calculate than outcome. And Alexander, since you are managing a portfolio, how do you measure your impact?
So we adhere to the impact measurement projects methodology that's out there on the web, and we display our impacts with a bullseye, where the center of the bullseye is maximum impact, and their investments are dotted around, and you're trying to move them into the bullseye. And like Greg was saying earlier, you got to ask for improvements. We have found that by asking our managers to improve their impact reporting, we've had some success, and it'll never be perfect, but you can keep improving. Point I would like to make is all investments have impact. As Greg says, it's just maybe good or bad. And I want to see the day when the term impact investing goes away, actually, and the whole industry thinks about risk, return, and impact all the time, not just sort of some of the time. Because if you're investing without thinking about the impact of your investment, you're speculating. You know, it might be buying Bitcoin. It's not a sound investment where you know what the money is doing.
Okay. So my next question is, I guess it's kind of wrap-up question because we are about at the end of our time. I studied the session telling you about the gap between people who have money and people who don't. And again, depending on which statistics you look at it, some says the 2% of population on 70% and 1% on 50%. But the whole point is it's not the matter of which number is accurate. It just demonstrates that people who have access to capital, they didn't need to be responsible because decisions they make do affect the whole capital market and the global economy. So I must say people who are actually attending this conference and like people who we are speaking now are the people who belong to at the top part of the capital scale. And so it is important that we do need to be responsible what we do with our money, not just saying this is my money, I can do whatever I want. And as Alexander said, being a good banker, but being a good citizen. I do think it's something that all of us should take it seriously and take pride in. So I'd like to ask each of you to have the last wrap up statement.
Jesus said, the poor will always be with you. And I'm sure he's right, but the poor got a lot better off in the last 100 years. So that's good. And we can do a lot in the next 100 years. But I don't think they'll get a lot better off if we carry on maximizing short-term returns without regard for our impacts. We'll find that nature is denuded and man is sort of out of community, out of sync and unwell. So we've kind of got to get a better operating model, and then the future is rosy. I hadn't mentioned earlier, I've actually done a lot of microfinance in East Africa and other places. You know, there are ways where we can bring financial tools to help the poor.
Wonderful. So with your impact activities, hopefully you will sustain another 350 years creating wealth and also impact. Wonderful. Greg?
Yeah, so you know, I think that when Diane is asked this question, you know, why do you do this? You know, she always says, "What else would I do?" You know, I think that you know, and I think it just demonstrates that those with access and responsibility for capital, given the challenges that the world face and the inequalities that we face, you know, with access to more money than anyone could ever need, what else is there to do with money other than to try to have an impact in the world and leave this place better for future generations. So I you know, what I would leave is, you know, this stuff can be done. There are other offices doing this very effectively, using capital to support communities around the world. I dropped my email in the chat. If you're a family office sitting there saying that sounded inspiring, we got money, we want to get it out there, we're always happy to talk to folks who are getting on this journey and headed in the same direction, since we need all the capital we can get.
Wonderful. Thank you. Well, I think we had a kind of a different approaches, but all heading toward the same goal. So any of the family offices, as Greg said, if you are interested in learning more about impact investment and even joining forces, please reach out to Greg. Any of those family offices or investment companies who likes to join forces with Alexander, please reach out to him, or even the foundations. That would be wonderful. Any of individuals or family offices who likes to utilize money by setting up social enterprises instead of nonprofit, creating sustainable impact, then please reach out to me. And you can get our contact information from the conference registry or by contacting Alex, the organizer. And I do hope that our conversation got you started thinking about it, and hopefully it'll lead to some actions, because we need a lot more impact-minded people to make a better world. Okay, thank you very much. There was
Thanks,
a
everybody.
hand raised. Okay,
Thank you,
now
Leah.
I pass it to you, Alex.
Thank you so much, Leah, for moderating the session. And Alexander, Greg, thanks for your insights. Much appreciated.
Thank you.
Great. Thank you very much.